In previous videos, we used the worksheet to identify and analyze the adjusting entries needed at the end of the accounting period. Those adjustments helped ensure that adjustments were recorded in the proper accounting period and that account balances accurately reflected the financial position of the business. Now it's time to move from analysis to action. In this video, we'll learn how accountants formally record adjusting entries in the general journal and post them to the general ledger. These entries update account balances and prepare the accounting records for the preparation of accurate financial statements. Although accounting software performs the posting steps automatically in most businesses today, understanding how adjusting entries are posted will help you understand what is happening behind the scenes and why adjustments are such an important part of the accounting cycle. The journalizing and posting the adjusting entries is step 6 in our 9-step accounting cycle, and we've come a long way. You've learned about analyzing business transactions, journalizing and posting them. Then we prepared a worksheet and sketched out the adjustments and the final financial statements. Now that we're satisfied with what we've drafted in the worksheet, we are moving on to actually recording the adjusting journal entries and posting them in the general ledger. As a reminder, when we previously worked on the worksheet, we only had 3 adjustments. One adjustment for supplies expenses of $500, one adjustment for prepaid rent for $4,000, and the third adjustment for depreciation of $183. Let's get started now with the first adjustment for supplies expenses. When we prepared the worksheet, we debited supplies expenses and credited the supplies account. We'll prepare the general journal entry by writing adjusting entries on the first line, the date into the date columns, and a debit of $500 to supplies expense, and a credit to the supplies account for $500. In a computerized accounting environment, the accountant uploads the journal entry into the accounting system and submits it for approval. The supervisor will then review, approve, and post the entry electronically. In our example, though, we need to post the entry manually. The process to post adjusting journal entries is the same as for all other journal entries that we learned about previously. So let's look at the 2 accounts, supplies and supplies expenses, that are listed in our first adjusting journal entry. We'll start with the supplies expense account and write the date of 12/31 into the date column, adjusting into the description, the journal page J3 into the posting ref column, and $500 into the debit column. This account has no prior activity because the balance before this entry was blank, and therefore we write the new balance of $500 into the debit balance column for this account. The next account we now need is supplies. The account already has activity and a balance of $1,500. So let's write the date of 12/31 into the date column of the supplies account, adjusting into the description, the journal page J3 into the posting reference column, and $500 into the credit column. We now need to calculate the new balance, which is $1,000. Once the entry is posted, we update the posting reference column of the journal entry to show the account numbers 517 and 121 of the accounts. We're now ready for our second adjustment for the expired rent for December. When we prepared the worksheet, we debited rent expense and credited prepaid rent for $4,000. We'll prepare the general journal entry by writing adjusting entries on the first line, the date into the date columns, and a debit of $4,000 to rent expense, and a credit to prepaid rent for $4,000. To manually post the general journal, we'll start with the rent expense general ledger account. Let's write the date into the date column, adjusting into the description, the journal page J3 into the posting reference column, and the debit of $4,000 into the debit column. This account has no prior activity, and therefore the new balance is $4,000. Next, we'll look at the prepaid rent general ledger account. This account already has activity and a balance of $8,000. Let's write the date into the date column, adjusting into the description, the journal page J3 into the posting reference column, and the credit of $4,000 into the credit column. We now need to calculate the new balance, which is $4,000. Once the entry is posted, we update the posting reference column of the journal entry to show the account numbers 520 for rent expense and account number 137 for prepaid rent. The third transaction is for depreciation. When we prepared the worksheet, we debited depreciation expense equipment and credited accumulated depreciation equipment for $183. To record that entry in the general journal, we write the date into the date column, depreciation expense equipment into the description column, and the amount of $183 into the debit column. On the next line, we slightly indent and write accumulated depreciation equipment into the description column and $183 into the credit column. To post the entry to the general ledger, we start with a depreciation expense general ledger account. Let's write the date into the date column of the depreciation expense account, adjusting into the description, J3 into the posting reference column, and a debit of $183 into the debit column. This account has no prior activity, and therefore the new balance is $183. The account we now need is the accumulated depreciation general ledger account. Let's write the date into the date column, adjusting into the description, J3 into the posting reference column, and $183 into the credit column. This account has no prior activity because the balance before entering this transaction is blank, and therefore the new balance is $183. Once the entry is posted, we update the posting reference column of the journal entry to show the account number 523 for depreciation expense and account number 142 for accumulated depreciation. In this part of Chapter 5, you learned how accountants formally record adjusting entries in the general journal and post those entries to the general ledger. These adjustments ensure that expenses are matched with the revenues they help generate, and account balances accurately reflect the financial position of the business. While adjusting entries may seem like a small part of the accounting cycle, they play a critical role in producing reliable financial statements. Without adjustments, revenues, expenses, assets, and liabilities could be misstated, resulting in inaccurate financial information for managers, owners, lenders, and investors. Think of adjusting entries as the final step in refining the accounting records before financial statements are prepared. They transform account balances from what was recorded during the period into what should be reported at the end of the period.